So let's get started. It's a pleasure to welcome you guys to the second in the series of Provost Graduate Student Lectures. And today's speaker is Lousy from the Department of Economics. He's a fifth-year student who came here from Beijing University. And he was telling me that he hopes to graduate pretty soon. And it's nice to know that he actually has a job waiting for him back in China at Wuhan University, which is great to see. We often worry about the employability of our students. And I think his talk today will be really interesting because it's something that's quite mysterious, which is how banks really operate. Yeah?
Okay. So thank you very much for coming to my presentation. And today what I'm going to talk about is kind of the main part of my dissertation. And my topic is lousy credit as banks compete more. So I'm going to provide both a theory and some evidence on bank lending over the business cycle. Okay? So let me start with some stylized fact as a motivation of this research topic. So what do we know is that the bank lending policies, both the interest rate spread, that is the difference between the interest spread charged by the banks on the loans, and the risk-free rate. Both the interest rate spread and the lending standards tends to move countercyclically over the business cycle. By countercyclical, I mean during boom period, both interest spreads and lending standards tend to be low, and the opposite happens in the recession. So the question I'm seeking to answer is that why do we have these countercyclical bank lending policies? And of course, you may ask the question that why this is a meaningful question. Then let me put this third bullet point in the first slides, which tells you why this is meaningful. So actually, answering these questions helps us to understand the recent financial crisis. How? We know that before the crisis, low standards, extremely low standards of the financial sector, mainly the lending standards imposed by those banks, lead to lousy credit. What is lousy credit? That is a large amount of credit to the borrowers who could never hope to pay back. And this is, of course, this period is kind of an extreme example in that we have extremely low lending standards. But from a broader view, that by answering this question, we may shed some light on how this phenomenon occurred. Okay. So then comes the question, if this countercyclicality in the bank lending policy can be very easily explained by standard economic theory, then, of course, we're almost done. And there's no research to be done. And that leads to this slide, which is I seek to answer the question why the countercyclicality is a puzzle. So let me first consider the countercyclical pricing behavior of those banks. So imagine the economy is in a boom with a higher than euro credit demand. So from Echo 108, we know that typically higher demand leads to higher prices. And if so, interest rates or interest spreads on loans should not be countercyclical. That is, during booms, it should get higher than during recession. And this cannot happen that the bank's pricing behavior is countercyclical. So this is the first puzzle. And the second puzzle is about the countercyclical standards. So let's imagine that if the information is perfect, that is, the banks knows exactly which borrowers is good and which borrowers is bad, then the bank will never lend to the bad borrowers. And accordingly, the lending standards in these terms should not change at all. So, because now you see that from the kind of the standard in the standard economic theory, those countercyclical lending policies seems to be a puzzle. And now this becomes a meaningful research question of trying to come up with a theory to explain these countercyclicalities in the bank lending policies.
Can I ask a question?
Yeah.
Well, I ask one way to that question. So the countercyclical pricing, you're basically saying that the demand is what fits in the economic theory question is the demand. So what about the supply side? So how do you control for the case that probably in the boom, a huge amount of money is flowing into the economy and it's the supply side?
Yeah. Of course, the price is determined by both supply and demand. And this claim is just about if you fix everything is equal and only change the demand, what's going to happen. And then towards the very end of the talk, I'm going to present some empirical evidence that directly answers your question that once you control the demand, once you control everything else in the economy and only change the demand, and you will see that the pricing behavior tends to be countercyclical. So we want to come up with a story about to explain this countercyclicality in bank lending policies. So what do? We ask our professors, and the professors tells me that, oh, you should look at this literature and that literature. But before looking at the literature, I want to answer a kind of a more basic question. That is, yes, when we are talking about the bank lending, presumably we have some kind of bank credit markets in which borrowers and lenders are those banks, interact with each other. And if we look at some facts about the U.S. banking sector or U.S. banking markets, we immediately see that there's an important kind of feature of this market, that this market is highly imperfectly competitive. And now we sort of have some institutional feature in our mind, and then I turn to the literature and try to see whether I can learn something from the literature to build up my story. So the first thing is that I turn to the industry organization literature, in which it has been well established that the procyclical competition can be used to account for the countercyclical pricing behavior of those firms. And what is procyclical competition? Procyclical competition basically means that banks tend to compete more, or in general, firms tend to compete more during booms or when demands are high. And what does this mean? What does it mean by saying compete more? Here, more competition basically describes a situation in which the realized profit in the market tends to move further away from the monopoly profit. So basically, the market power shrinks because those firms tend to compete more. Okay, and in this regard, we have a seminar paper by Rothenberg and Solana, published in American Economic Review almost 13 years ago, setting up a very simple and elegant dynamic model to model this procyclical competition and countercyclical pricing. Okay. And secondly, I turn to the finance literature, which has investigated how competition interacts with banks' screening decisions. And naturally, banks' screening decision, that is, how banks screen bad borrowers from good borrowers, corresponds to banks' lending standards. That is, what's the kind of the standards the banks use, such that whenever a borrower cannot meet those standards, credit will not be extended to those borrowers. And therefore, in order to talk about, to try to think about lending standards formally, I need to look at this story. And of course, I list here 3 kind of classical papers in this literature. And actually, I borrowed heavily on those papers in setting up my model. So before jumping into my model, I would like to say a bit words about my contribution. So it turns out that I'm the first one to develop a fully dynamic and tractable model of bank lending under competition. And of course, this is a pretty bold statement, but after tracking those literatures in the past couple of years, I realized that yes, I'm the first one to do this. So the model I'm going to develop endogenously generates procyclical competition, which induces countercyclical pricing behavior and countercyclical lending standards used by those banks. And to further verify my theoretical prediction, I got some very nice empirical evidence from a kind of well-known data set. And basically, what I can show is that I confirm that bank competition tends to be procyclical, and this procyclical competition accounts a lot for the time variation of banks' lending policies. So let me start with my model, my little model. So the basic structure of the model is like follows. First, the time. Time is discrete with an infinite horizon. And there are basically 2 types of agents in the model. The first is unit mass of borrowers. The second is there are identical banks, and I use little I to index those banks. There's no entrant and exit of those banks. So technology. What is the technology of this economy? So basically, there are 2 technologies in this economy. The first one is that borrowers has an investment technology that once they can borrow enough money to run the investment projects, they're going to generate some output at the end of each period. And moreover, banks have a kind of a common screening technology which can be used to distinguish bad borrowers from good ones. Okay, preference, pretty standard. For both agents, I assume that they are risk neutral and they are maximizing discount values of payoffs in discount value of stream of payoffs from now to indefinite future. So I'm considering an aggregate shock, which is what I call the credit demand shock, which follows a Markov chain. And I'm going to use this credit demand shock to generate the business cycle environment in this model. So let me describe what is the borrower's investment projects. So basically, in every period, each borrower draws an idiosyncratic shock theta with taking 2 values, either theta G or theta B, standing for good and bad. This idiosyncratic shock is ID across borrowers and over time. And the theta, this is important. Theta is a borrower's private information. That means only this borrower knows whether he is good or not, and nobody else knows it. Okay, so each theta borrower has a 1 period investment opportunity that he can use an initial investment of size Z and to put into the project. And with the probability theta, the project will succeed, and then it will produce an output of Z times X, so the unit output is just X. And with the complementary probability, the project is going to fail, and in this case, the output will only be C. And what I'm assuming is that X is greater than 1 and greater than C. So I can write down the per unit expected net present value of this project theta. So it is the probability theta times the output when succeed, and plus complementary probability times the output when failed, and minus 1. This 1 represents the risk-free rate, which I have normalized to 1. And I'm assuming that the good borrowers have a positive NPV project, and bad ones only have a negative NPV projects. Okay. So now let's talk about the financing side of this economy. So what's going to happen is that the borrowers, I assume that each borrower is protected by limited liability. The borrowers, although they have a limited liability, they have no other resources to make the investment. And what they can do is that they must borrow money from the bank. And how do they borrow money from the bank? So at the beginning of the period, each bank is going to publicly offer a loan contract, which is two tuple. That is, the first element is R, the second element is Q. And this R is the gross interest rate on this loan, and the Q is the screening intensity that the bank is going to use in order to screen those borrowers. So each borrower is going to apply for a loan of a given size Z from one bank. This Z, remember, which also represents the size of the loan, also is the realization of the credit demand shock. So in the good time, you have a bigger Z, and in the bad time, you have a lower Z. And I'm allowing the borrower to borrow only from only one bank. And this turns out to be a technical requirement, but not a very demanding one. So now let's suppose that a bank has approved a loan to lend money of a size Z to a theta borrower at some interest rate R that is greater than or equal to 1. Remember, this 1 is the risk-free rate, so the interest rate on the loan can never be lower than 1. The gross interest rate can never be lower than 1. And now the bank's unit expected payoff can be calculated in the following way. This is eta theta, means a unit payoff of a loan of interest rate R to a borrower theta. It's just theta times R. When the project succeeds, the borrower has enough resource to repay the loan. So it will repay in full R. And with complementary probability, the project fails. And what's going to happen then is that the borrower do not have enough money to repay back. So the borrower can only pay what's remaining in the project, that is some output C to the bank. And this is the payoff to the bank, and minus 1 is the funding cost of this bank. And I'm assuming that banks have an elastic supply of funds at the risk-free rate 1. And in the similar manner, I can write down the borrower's unit expected payoff, theta probability of success times this is what the borrower is going to get when the project succeeds, minus R is the gross interest rate.
The probability 1 minus theta, you get C back from the borrower.
Right, yeah. And basically in that case,
C is what the investment has yielded, right? So
yes.
The borrower gets 0 in this case.
Right, because the borrower can never pay. Remember, C is less than 1, and the gross interest rate is actually greater than 1. So in that case, if the project fails, then the borrower would not have enough money to pay back. So it will basically default on the loan and pay whatever is remained in the project, that is C. and C has the interpretation of collateral value. Okay, so now, as we have argued, as we have assumed actually, that since for bad borrowers, their net present value of their projects are negative. Therefore, bank lending to bad borrowers is never profitable. Remember that we have this limited liability so that the banks can never extract more than the net present value of a project. And banks will have this incentive to distinguish good borrowers from bad borrowers. And how can those banks do this? They're going to use the screening technology. They're going to screen the borrowers and try to figure out who's good and who's bad, and then makes the lending decision. So in particular, I'm considering a screening technology in the following way. That is, at intensity Q, the screening process is going to generate a signal phi, which takes two values, either big G and big B. I'm going to say this as a good signal and this B as a bad signal. And this signal satisfies the following restrictions on their conditional probability. That is, conditional on the borrower is a good borrower, the probability of getting a good signal is Q. And the conditional on the borrower is a bad borrower, the probability of getting a bad signal is also Q. Therefore, as you see, if you increase the value of Q, the screening process becomes more and more accurate. If Q is 1, then this signal becomes perfect indicators of whether the borrower is good or not.
So this is your choice.
Yes, Q is a choice of the bank.
You want to talk about the cost for the?
Yes. So before the cost, let me say this. This Q, screening intensity Q, is going to determine the posterior probability of having a good borrower conditional on that the signal generated by the screening process is phi.
Should not Q be open half and closed half? Because if it's just 50%, then it means the technology is useless.
Yes, but
So
that
it should be probably open.
right. But it's just a convenient way of writing down this, and if you assume that the cost of having a 50% screening intensity is 0, then that makes no difference. Now, here's what's the cost of this screening technology. Banks will pay a cost Z times CQ for screening a borrower at intensity Q. Why do I multiply this by Z? Remember, the loan size is Z. Therefore, if I have Z here, then basically when I calculate the unit payoff of those banks, it cancels out, so it simplifies algebra. And I'm going to assume that this cost function of screening is a convex function with standard properties. So what's the timing of the model? So at the beginning of time t, the aggregate credit demand shocks realizes. And then followed by the realization of these investment opportunity shocks to each borrowers in the economy. Next, banks is going to post loans publicly. That is, bank number 1 is going to post a loan L1. Bank number N is going to post the loan Ln. So this is the profile of the loan contracts in the economy.
Z times C. So is that saying the guy goes to the bank asking for $10, screening him is
Yeah.
cheaper than screening the guy who asked for $100 million?
Right. That also makes sense, right? Yeah, but let me assure you that even if you do not multiply the cost by the size of the loans, the same results just goes through and actually even stronger.
That's how it works.
Yeah, just algebra. Now come back to the timing. After the banks post a loan publicly, each borrower is going to apply for a loan, L, from some bank I. And after that, okay, the borrower goes to the bank, and the bank is going to, okay, say, let's sit down and you submit your profiles, and I'm going to review those, do the screening process, and then I will tell you whether you're qualified a loan or not. And the banks I basically screens the borrower with the intensity Q and makes the lending decisions A or D. A stands for approval, D stands for denial, based on the screening result. Basically, based on the signals the banks obtain from the screening process. Okay, and after the screening process, if the borrower is approved a loan, the borrower is going to get a loan with the pre-specified interest rate R. And if its application is denied, then the borrower needs to wait until time t+1 to apply again. And and towards the end of the period, the payoffs from the investment will be distributed to the borrowers and to the banks, and then the economy ends and enters into the next period.
So when the borrower follows the, say, type of loan, is he like acting strategically to the bank, for example? Is it like perhaps I take expectation on the bank's interest rate and perhaps the intensity of his screening policies, and then I'm going to apply for a loan, or is not?
The borrower will observe the loan offerings of all those banks in the market, in the credit market, and then he will just pick up the best loans. Yeah, right. Exactly. So the timing of this lending process suggests that within each period, what we have is actually a lending game. It's a game between banks and borrowers, and also among those N banks. So let me be more specific about this. So first, let me specify the strategy of a borrower. For a type theta borrower, its strategy is to choose which loan, Li, to apply for, given the loan offering profile of all those banks. And what's his payoff? His payoff is basically, this is the payoff once the borrower got the loan. This is the success probability times the difference between output and interest rate. Multiplied by this p theta. What is this p theta? The p theta denotes the approval probability for this theta borrower applying for a loan Li. Yeah, it will be determined in the equilibrium of this lending game.
It should be some kind of mixing by the banks.
It turned out that I structured the model so that there's no mixing. There is a unique pure strategy equilibrium of this game. Okay? So now what is bank's strategy? Bank's strategy is, first, the banks need to choose which loans to offer, to post publicly, and then the banks need to choose whether to approve or deny the loan when there is a borrower applies for that loan. So very simple, kind of.
So you're saying that probability E theta would be either 1 or 0?
Actually, it's going to be determined by the screening intensity. You will show in 2 slides. Okay? So what is the bank's payoff of doing all this, choosing all this strategy? So let us record that the bank's unit payoff, expected payoff from lending to a theta borrower at interest rate R is just given by this expression. And now, bank's unit payoff from lending to a borrower who has applied this loan L at this bank and who got a signal fee out of the screening process. And the unit payoff from lending to such a borrower will be determined by the following expression. Here is, record this is the conditional probability of having a good borrower by observing a signal fee. And this is the probability of having a bad borrower. And I'm multiplying with each probability with the payoffs. This one is the payoffs from lending to a good borrower. This is the payoff from lending to a bad borrower. And this is the overall expected payoff from lending to a borrower who got a screening result of fee. Okay, now what we can do is we can write down bank's I's net unit payoff if the borrower applies for a loan, LI. What's going to be this net payoff? It's going to be the payoff from lending minus the screening cost. And what's the payoff, overall expected payoff from lending? This will be the probability of observing a signal G times the expected payoff of lending to such a G borrower plus the corresponding case for the signal B borrower. And why do I have this max operator here? That is, basically what's going to happen is that if this payoff to a fee borrower is negative, that is, the probability of this borrower, of this fee borrower, turns out to be a bad one is too high, then it's never profitable to lend to this guy. And therefore, if this whole term is negative, then the bank will simply stop lending to this guy. And therefore, in this case, the bank will just deny credit to this guy and only lend money to the guy with a positive expected payoff. Okay? So this completes the specification of the lending game within each period. And what's going to happen in the economy is that this lending game is going to be repeated over time again and again. Now, the interesting thing in this model is that let's talk about the determination of the lending standards in this model. So, in order to derive the following results, I need to impose certain parametric restrictions on the model's primitive parameters, but those requirements turns out to be only mild ones, so relatively easy to be satisfied. So under these mild parametric assumptions, what's going to happen in the lending game is that banks will always choose an efficient screening intensity QE such that all borrowers who got a bad signal in the screening process will be denied credit. So basically, banks will only lend money to those borrowers who receive good signals in the screening process. And moreover, for each given interest rate, gross interest rate R, such an efficient screening intensity QE is going to be determined as the solution of this maximization problem. That is, for given R, the banks is going to maximize the net return, that is expected payoff minus the screening cost, by choosing an appropriate screening intensity Q. It turns out that this screening intensity is increasing in R. And moreover, if borrowers do choose this loan contract L with interest rate R and with efficient screening intensity Q, the profit rate function of the banks can be written in the following way. That is just you replace Q with the efficient Q. And this profit rate function turns out to be a function of R only, which is increasing and has all those nice properties. Now, what's the preference of those borrowers? So given an efficient contract RQE, the expected payoffs to good and bad borrowers are, to good borrowers, it is the good borrower's success probability theta G times the payoff when the project succeeds times QE. Remember, what's going to happen in this model is that banks only lend to the borrowers who receive a good signal. And for a good borrower, the probability of receiving a good signal is just QER. And for the bad borrower, the probability of receiving a good signal is 1 minus QE. Why? Because by assumption that for a bad borrower, the probability of getting a bad signal is Q. Therefore, the probability of getting a good signal instead is just the complement. So it turns out that both types of borrowers prefer a loan with a lower R. Remember this, now this becomes only, those two expressions becomes only functions of R. Now, let this boldface L denotes the loan offering profiles, and well, each loan offering is an efficient loan contract, and let this L min be the contract with the minimum R interest rate R. Now I can write down bank's profit function at the very beginning of the period as follows. So bank I's profit rate, actually not profit rate, it's the gross profit, can be written as, now if bank I's loan offering happens to be the loan contract with the minimum interest rate, then the bank is going to, this is the profit rate the bank is going to receive, times the Z is just the size of the loan, divided by N min. This N min means the number of banks offering this loan contract L min. So very standard kind of resembles the case of a standard Bertrand model of price competition. And of course, otherwise, if the bank offers a loan contract with the interest rate greater than the minimum one, no one is going to go to that bank and the payoff will be 0. Now, let's talk about, give a quick review of the repeated game case. I do not want to get into too much detail about the repeated game, but basically what's going to happen is that the repeated lending game can be solved as a repeated game among those n banks with profit function given in the previous slides. Moreover, as you know, that for a repeated game, there are a lot of equilibrium. And I'm going to focus on a particular one, which is the optimal symmetric spaghetti perfect equilibrium, or the optimal SSPE. So I will make use of standard results in the repeated game literature to solve the model. And in particular, what I'm going to do is that I'm going to use the Grimm trigger strategy to construct the optimal SSPE.
Is there non-symmetric?
There will be no non-symmetric equilibrium because basically the entire setup is symmetric, and if somebody plays something different, then it cannot be in equilibrium. Okay, let this delta denotes the common discount factors for all those banks. Now we are ready to state the first main result of the model. So suppose we have the credit demand shock ZT which is IID over time. This is the simplest case, taking two values, ZH and ZL, and a piece more terminology, that is when credit demand is high, I would say that the economy is in a boom, and otherwise it is in a recession. And then this proposition says that there exists an upper bound of the discount factor delta bar, that if the discount factor is lies within this range, then in the optimal SSPE, what's going to happen is that in a boom period, the equilibrium interest rate R star, equilibrium lending standard Q star, and the equilibrium profit rate pi star is going to be lower than their counterparts in a recession. And especially for a lower realized profit rate, this lower profit rate corresponds to my notion of more competition. Okay? So, and the intuition for this result is that with IID shocks, the equilibrium incentive constraints, that is the incentive constraints for those banks to not deviate from the equilibrium strategy profile, can be written in the following way. This would be, the left-hand side is the payoff, is the deviation incentive for those banks. That is, the banks once deviate a little bit from the equilibrium strategy, what the bank is going to get is this n times the profit. Basically, it's going to undercut a bit of all the other banks and acquire the entire market share, and this is why it is multiplied by n. And if it stays with the equilibrium strategy profile, then in the current period, the bank is going to get this, it's going to receive this much of profit, and in the future, it's going to receive a discount value of this much of profit. And now, what's going to happen in a boom period is that this high ZH during boom periods causes deviation incentives to be too high, that this inequality cannot hold. That is, this high profit rate cannot be supported by the continuation values of the equilibrium. And therefore, banks must compete away this extra profit by lowering its interest rate R and lowering its lending standards Q, just in order to shrink the profit margin. Now, as an extension of the IID demand shock case, what I can show is that I can assume that ZT is just a Markov chain, an arbitrary Markov chain, with two states, ZH and ZL, with the same interpretations as before. And what's going to happen in this case is almost exactly the same as in the previous proposition. The only thing differs, because of the more general Markov structure, is that this upper bound, the delta bar, is going to change.
What's the benchmark when you say lower?
The lower, what I'm comparing is the equilibrium outcome in boom period with equilibrium outcome in a recession. So everything is relative to a recession. Okay, and almost the same intuition as before applies to the general case of a Markov shocks to the economy. Okay, so let me quickly discuss some empirical evidence. Any question? Let me discuss some empirical evidence on this to support my story. So what I do is that I extract some very interesting information from this Senior Law Officer Opinion Survey, which is a quarterly survey conducted by the Federal Reserve Board. And in this survey, there's a very nice question that asks those banks participating in the survey that what's the reasons for changing standards or low terms that is the interest rate and some other terms. And there are a bunch of alternative answers to this question, like capital position, like uncertainty of economic outlook, and competition. And the precise paraphrase, the wording of the question is kind of, now if your institution has lowered your lending standards and lowered other loan terms, are you facing more competition from other banks? And was this competition very important, or somewhat important, or not important at all? And therefore, basically, this answer is being rated by 0, 1, 2 in the case of easing. That is, if it's very important, then it's going to get a rating of 2. Now, if you calculate the top 3 reasons for easing lending policies by what's the top 3 means? Top 3 means the average scores, the average ratings each answer receives across the more than 100 surveys over past 2 decades. What you get is that competition is being rated consistently as the most important reason for easing lending policies. And as you see, the mean score, the mean rating is 1.2, and the second one, as opposed to the second one, which is economic outlook, which receives an average rating of only 0.4.
So how many choices they can choose? No, I mean, competition, capital position, all these kind of the items. So
Yeah.
Is it that I have a manual of reasons and the guy is saying that you can choose the top 3, or
No, you can choose anyone.
anyone? But so this raises this question that probably the guy looks at the manual saying, oh, competition, well, fine too. So it's not necessarily that they think that competition is more important than the other. Because, well, competition
Business guys usually have this competition.
Right.
So,
Yes, but competition, like if you really want to try hard to kind of interpret what does this mean by more competition, so competition is always about a counterfactual. If you do not face these crazy guys, these crazy banks charging this crazily low interest rate, then I would be better off of charging a higher interest rate and getting this nice profit margin. But because of some other guys' actions, because of some other guys' behavior, what I can do is, in order to get this customer, in order to get these borrowers, I have to lower my interest rate to attract them.
Much more due to beliefs than actual behavior.
Yeah,
They
there's
believe the guys are doing something. The guys do because they believe, and somehow
there's
it's completely subjective.
right. Here's one element in this story is that kind of whether this is due to the kind of potential competition from other banks. That if I do not do something, then the other guys is going to do something really harmful to me. But again, I would argue that this effect is also being captured by the model. Like if I do not kind of do something to lower my price a bit, then some other guys is going to do this without violating the equilibrium incentive constraints. Actually, that will help to restore the equilibrium incentive constraint. But at the end of the day, of course, I'm assuming that everyone is being perfectly rational. They have this perfect insight about the economy and about working. So, yeah. So, kind of an essential element of my story is that the competition turns out to be procyclical over time. So it would be nice to know whether competition is procyclical. So here's one way of looking at this question. That is, I can calculate the kind of the mean score across all the cross section of those banks of their rating on the competition. So it's from -2 to 2. So the higher this rating is, somehow we can argue that the more competition those banks are facing in the market. And if you draw the cross-sectional mean over time, what you see is a clear, very clear pattern of pro-cyclical competition. That is, during booms, competition really picks up, and during recessions, no one would like to compete for some additional, marginally additional loans by those borrowers. Now, we can put all those evidence from this senior loan officer opinion survey together and draw the time series of the past 2 decades. And what we see is that here on the left-hand side, you have the scales for standard and the spread. And this 50, like this number 15 means that more than 50% of those banks are reporting that they are actually tightening their lending standards. So take a look at this point. Around the internet bubble, that means there are more around 50% of banks reporting that, oh, we really tightened our lending standards and the loan spread. And correspondingly, if you look at the level of competition gets really low. And something opposite happens in the boom period following the internet bubble and just prior to the subprime crisis. What you see here is that those banks are really competing aggressively with each other, and that's really pushed down the credit standards and the interest rate spread. This kind of pro-cyclical competition drives the counter-cyclical lending policies. So let me wrap up at this point. So what I do in this paper is that I develop a tractable dynamic model of bank lending under competition. What I show is that the pro-cyclical competition induces counter-cyclical lending policies, that is lower loan spreads and lower lending standards during booms because of more competitions among those banks. Moreover, I provide some empirical evidence confirms, here's a typo, confirms the cyclical prediction of the cyclical pattern of competition and lending policies over time. And the kind of the takeaway information I want to give to you is that let's going back to the kind of the very beginning, the motivation I talked about at the very beginning. That is, what's really kind of a behind the scene factor of driving down the lending standards before the recent subprime crisis is really those incredible amount of bank competitions, as competitions among those banks, or even competitions among banks and some other non-bank lenders in the credit markets. That's kind of a really strong economic force of changing those behaviors, especially the lending standards of the financial world. And therefore, perhaps we should pay more attention to this competitive side of the credit markets. Then we typically pay to some other factors. And this is just finishes my presentation today. And thank you very much for coming. And any questions?